how do I buy a car? What's the best way to do it? Do I finance it? Do I pay cash for it? Do I beg for it?
Please.
What is the best way? And even better yet, there's a popular strategy that's getting out there today with infinite banking and whether you should use it for the car. I want to talk about whether you should be doing that instead. Okay, so right now, it's no secret, interest rates have been skyrocketing like crazy. I just looked on my bank's website. It's almost 7.5% for a car loan right now. Even to get it fixed, 7.5%. I mean, you remember just a couple years ago, we're paying like 3 or 4%, much higher now. Now, you might look at it and say, well, okay, it's like double the cost, still 7.5%. It's only a few percent more than 3 or 4%, but it's significant and it makes a difference on your payment to a degree, but it doesn't help that cars are getting more expensive too. And so there's this big debate because even used cars are more expensive. What do we do? How do we afford this? In fact, I just looked it up. The average car payment right now is $1,200 a month. Do you know that my first mortgage payment was $750 a month? And that's because I had to pay stupid insurance to the mortgage company for $100 a month. And so the real question is, do we finance it or not? Or do we pay cash? Well, the truth is, if you don't have cash right now, you probably only have one option. It's probably to finance it. And that's gonna be okay. If you were to finance it, here's my general advice, is get the longest term loan possible. Now, I know somebody out there will say, well, why would you do that? Especially because it's a depreciating asset, which is true, and it's not a real asset. So why would we just stretch out those payments? Because that's safer. You can always pay off a car early, but you can never tell a bank to say, you know what? I don't have as much money anymore. That minimum payment, I can't even make that. Can you make my payment smaller, please? Because I really need you to help me here.
You're right. Small price.
Just so you know, when you need money, that's when the banks never want to give you money. Okay, the best thing to do is upfront, set the terms to be a longer term loan. Make the payment as low as you can. This, as a warning, is not to justify you buying a higher priced vehicle just because you can quote unquote afford it, right? I'm not saying that. I'm just saying it's better to have a longer term loan and pay extra on the payment by not being required to make a large payment than to do the opposite where you have a large payment and you can't even make that payment and it destroys your credit and it destroys your possibilities for financing in the future. That's one of the key advice I'll give you from my own personal experience. So right now there's even 72-month, like 6-year car loans. There's even 7-year car loans available to be able to stretch out those payments. I recommend definitely not more than much over 5 or 6 years, 7 if you have to. But usually 5 years is kind of like that nice magic number if you can get it. And so there's an argument to be made about paying cash for cars, right? So you can finance it, you can pay cash. I would say this. Do not use all of your money to pay cash for a car. That's a scary place to be. If you try to drain all your emergency fund and everything to try to pay cash for a car, I would rather have you keep a good amount of cash that could pay off a car and finance it than to pay cash and have no savings left over. But there's a third option that's out there too. There's a third option talking about how to use this infinite banking policy to buy your cars. It's a very popular thing in the infinite banking world, using your whole life insurance cash value, the tax-free savings account, to go and buy your car, but then you pay yourself back the payments. And they always say that you're paying yourself, right? Well, let's dig into that. Let's actually watch a video where they talk about how this concept works.
Get all the money back for every G-Wagon I buy, drive, and own, and you can do the exact same thing. We all have something that we love and we want to buy. So when I bought this, the one thing I will tell you is I bought it very different than the way that you probably buy cars. You see, I bought this G-Wagon using my own private banking system. I don't own a bank, but I created a private banking system. The bad news is, to buy this G-Wagon, I had to save up enough money to be able to pay cash for the car. But you see, my cash, I didn't put it into a bank. I put it into a specially designed whole life insurance policy where my money gets to earn guaranteed interest and dividends uninterrupted. Then what I did, I took a loan from that whole life. So I took the money out of the policy and I paid cash for the G-Wagon. Remember, I have a private banking system. I'm not going to steal from my bank. So what I did when I bought that vehicle is I figured out how much my monthly payment would be if I were to have financed that with a regular bank.
My friend Chris here, he's talking about infinite banking and he talks about some of the same stuff I talk about too. But he's talking about how you have enough cash to buy the car, but instead you run that money through by paying your premium into your life insurance policy. That doesn't just go to the death benefit, it goes into your tax-free savings account called cash value. Then what you do is you actually get a loan from the insurance company, right? So the insurance company gives you a loan to then go and pay that. And then what you would normally have paid for that car payment, say that the car payment would have been $500 a month, you just take that $500 a month and pay back into your policy. So he did a good job describing that. And he's saying like that's the best way to finance it, right? Now, again, he's talking about like it makes it seem like you're always paying yourself back. It's interesting because here's some comments that come up from this. Bruce here, he says, I wish you would stop saying, I then take it out. You don't take it out, you borrow against. You are confusing the general public because they realize it cannot work like that and still earn interest and dividends. It's a simple change you can make. He's actually not wrong. So here's the confusing part. Everybody makes it sound like it's like this, just a savings account. You put money in, you pull it out, you buy this car, and then somehow, magically, you're supposed to be working better. And like you get this loan, and they make it sound like it's a 401k loan where it pays itself back interest. You're not doing that here. Here's what it really looks like. So let's take an example right here. Let's just say you're buying this car for $30,000, right? This is a $30,000 car. He's saying put your money into your policy. Now, if this were a brand new policy, just so you know, costs are going to come out, insurance costs are going to come out, and in some of these guys' policies, a lot of it comes out, sadly enough. They overcharge you on this. By the way, Dave Ramsey would actually not like this method. Now, let's just go with this here. Let's just say that you do have $30,000 inside your whole life policy. This is the money that's earning compounding interest tax-free, and you're earning generally about 5 to 6% tax-free on this money, right? But what you're going to do instead is you're actually going to take a line of credit. You're going to borrow money from the insurance company. So you're not pulling the money out of here. You're actually getting it separate. Really, you're getting it from here. This is the life insurance company, right? They're actually really the ones that give you the money. They'll give you that $30,000. Now, you will be able to pay cash for that car. So like what Dave Ramsey talks about, you will be paying cash. But make no mistake, this is the big confusing point. You are borrowing money. The difference is you're borrowing money from the life insurance company. Now, the great news is there is no minimum monthly payment. You can pay this loan back however, whenever you want. So unlike a bank loan where it could destroy your credit if you miss one payment, that does not happen here. So all things being equal, this is a safer route to go. And remember, there's still $30,000 in here that could pay off this loan. Really, all they're doing is giving you a loan to be able to pay for this. Now, that $30,000 comes out, you buy your nice little car. There you go. That is your very aerodynamic car. It looks kind of like a little, it looks like a little nose there and eyes, and there you go. You got like a little rat running around. So anyways, that's your car right here, right? So you bought your nice little red car here for $30,000. Now, what Chris has been recommending here, he is saying on this video, is pay back $500. Now, he was making it sound like you're paying yourself back $500 a month. But no, you're not doing that. That $500 is going back to the life insurance company to pay down this loan. That's the difference. You are getting charged. By the way, you're getting charged somewhere in the ballpark between 5 and 6%. Now, some would say, why is that worthwhile? Why should I do that? Well, the reason is because this is 5 or 6%, but as you take that $500 a month, and this is the key, this is why he's teaching you this strategy. You pay $500 a month to this, the interest is not $500 a month that you're being charged. The truth is, the interest on this thing, you're probably paying more like, $100 a month. So anyways, about $300 or $400 a month of this money is going to pay down this loan balance. So as it goes down, you're still being charged 5 or 6%, but say you pay it down to $25,000 next, right? Well, when you do that, just like any normal car loan, when you pay it down, you're paying less and less interest. The interest rate's the same, but now you're only paying 5% on $25,000. So instead of paying $1,500 a year, now you're paying $1,250 a year, right? And so that just goes down more and more, meaning more and more of this money goes here. But over here, this money compounds. So that 5 or 6%, you make 5% on there, you make $1,500 or so. Now the next year you've got $31,500 because remember, you're not pulling out your cash. You're leaving it there to grow. So that money is growing now by $31,500. Now you're making 5 or 6% on that. That means the next year you're about $33,000 and say $100 and change. And so it compounds. So it looks like this. Compounding interest, you ever seen the curves? Goes like this, where simple interest goes like this. It goes down over time. That's the key factor here. That's what makes the difference. That's why he's telling you to make a payment to yourself so that the numbers still work out in your favor. Otherwise, there'd be no reason to do this. You'd make no money or lose money in this case. Now, although that's pretty cool, there are some reasons not to do this. Did you know I actually just bought a car? I did. I actually just bought a brand new car, but when I bought my red car, it's not like this. It looks much cooler than this little rat thing that I just drew on here, right? That's a cheap used car. But I bought a new car, and they gave me different financing options. We knew we could probably pay cash or not. We even had a large down payment we were gonna put on it anyways. And so on that car, here's what we did instead. And spoiler alert, I did not use my infinite banking policy. So when we bought this car, we bought it for about $55,000, but we put $20,000 down payment on it, so it only has about a $35,000 loan. Now we had a choice. Do we just pay it off completely, or do we finance it? Well, one of the financing options we were given is if we do a 3-year car loan, which is a more expensive monthly payment, if we do a 3-year car loan, guess what my interest rate is? 3.7%. Now, a lot of people, when they learn about infinite banking, they'll say, we should do infinite banking because you pay yourself back interest. You don't pay any interest. Wrong. You're still paying interest. I could use my infinite banking policy, but why would I get a loan out for between 5 and 6% when I can get a loan from the bank at what? 3%, right? I'm getting a 3.7% loan. I'm still paying a bank back. Even when I do infinite banking with my policy, I still pay back the bank called the insurance company. I'm getting cheaper interest here. Remember, I'm still paying the same interest. If I were to get, say, a 6% line of credit on my life insurance at $35,000, well, guess what? I will be paying about $2,100 per year in interest. But at 3.7%, if I do that instead, well, guess what? Now I'm paying only roughly about a little over $1,000 a year. I'm saving about $1,000 a year in interest right from the get-go because I got a bank loan at 3.7% interest. Yes, I could have paid cash for it, but I know that 3.7%, which, let's be honest, inflation's bigger than 3.7%. Really, I'm pretty much saving more than that. I'm probably netting a positive return on my car by not using cash, and then I can even go and invest that money for make way better than 3.7% anyways. All right, so there you have it. I financed my car with the bank. Dave Ramsey wouldn't like it, and apparently other infinite bankers wouldn't like it because I didn't use my infinite banking policy. But there are reasons to use it. In fact, if you want to go deeper down that rabbit hole and find out how to get the best, absolute highest returning infinite banking policy possible, check out our next videos here in the infinite banking playlist. Should you finance a car or should you pay cash for it? That's been a big debate, especially as interest rates have gone up. Or even better yet, do you use your infinite banking policy to use it, to buy this? Well, guess what? I just bought this bad boy right here. I just bought this car brand new. I did not pay cash, and I did not even use my infinite banking policy. I used the bank. Why? Because I was able to get a 3.7% interest loan on this rather than paying 5 or 6% to the life insurance company. So even though I love infinite banking, even though we always preach about it, I don't always buy my cars. In fact, I'd rather use the bank to buy my cars and my houses than use my infinite banking policy where I can invest that money and make more with it instead.